Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 136, and it's been another dramatic week in the markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
So after the close last night, Amazon came out with good numbers and the futures are up this morning, but still, Nasdaq is well down from recent peak. Now, the ECB met and held rates at 4.25%. We think it's very likely we have seen the peak in Eurozone interest rates. In the US, Chevron announced a deal to buy Hess in a deal worth $53 billion all share, and that will create the world's second largest private oil producer. Separately, the IEA has forecast that world oil demand will peak this decade. We'll show you the chart in a bit. So Bill Ackman sparked a bond rally early in the week when he announced that he had closed his Treasury short position, sparking a volatile week for bonds, which rallied and then didn't. In China, Country Garden has officially defaulted on its dollar bonds. There, as we have been talking about over recent months, the Chinese property sector continues to weaken, and sales in Country Garden were down something like 2/3 year on year. And it is likely we'll see other defaults in the Chinese property sector. Watch this space. The UAW strike, which affects GM, Ford, and Stellantis in the US, has been settled in the case of Ford, with Ford agreeing a 25% pay rise over the next 4 years for its auto workers, including an immediate 11% hike. So wage inflation may be coming down, but for unionized workers, that is a very big pay rise, and that will tend to keep inflation persistent. And finally, the US House of Representatives has elected a speaker in the form of Mike Johnson, who's a hardline conservative and a Trump supporter. Whether that will lead to an outbreak of sense and compromise in the US government is open to question. So some charts relating to news. Well, the ECB held rates, and this is Eurozone inflation, and it's coming down. It's coming down rapidly and is expected to keep on doing so when Eurozone inflation numbers are reported, I think, next week. And the market is now expecting the ECB to start cutting rates in the start of Q2 next year. It's a rational market, we like to think, but then Bill Ackman comes out and says that he's cut his Treasury short position. Reminder, the US Treasury market is meant to be the largest market in the world, and yields promptly dropped by 15 basis points. It's absolutely astonishing how Bill Ackman's personal or hedge fund positions affects the outlook for the US economy. I just don't know. Now, this is the merger of Chevron and Hess, and that's the second line, and the merged entity will produce 4.4 million barrels a day, making it the second largest oil producer in the world after Exxon Pioneer. And Country Garden has defaulted on its dollar bonds. It's down here, and this is a list of all the Chinese property developers who have so far defaulted. Expect that list to keep on growing. And the reason that they're defaulting is that their sales have dropped enormously. So Country Gardens sales have dropped 2/3 this year compared to 2020. And going back to that previous list, you'll see Vanke and Sunak are not on the list of defaulters, but their sales have also fallen very sharply. So expect some further defaults in the near future. And this chart shows Chinese properties under construction, that's the dark blue, and completed, that's the light blue. And so you'll see that there's been very little change in completions over the last decade, but the developers have taken in a lot of money to start new developments. And so Chinese purchasers of property are going to be very unhappy while all these projects remain uncompleted. And that presumably will be a huge drag on the property market going forwards. Who's going to buy a new property off plan when experience shows they don't get completed? Now, this is the IEA's forecast for world oil demand. And you can see that they are forecasting that global oil demand will peak this decade and then decline very slowly. Now, the merger between Hess and Chevron shows that they don't believe that's true. They think oil demand will keep on growing, giving them significant pricing power. And the US has elected Mike Johnson as Speaker of the House, and actually the market doesn't believe we're going to have a shutdown in 3 weeks' time. Chance of only 30%. So although he is a conservative Trump supporter, they think that the Republicans will allow the government to be funded. And on to this week's economic data. Richard, the UK.
Thanks, Keith. So the UK PSBR, which we look at very regularly, is a little bit better than was expected, but it's still hugely negative.
Yeah, and I noticed that the Chancellor and actually the commentators were talking about the possibility of tax cuts. Well, I mean, how do you get there from here? Because the deficit has been much better than anticipated, but it's still awful.
Yeah. I don't know, Keith. I mean, it's a mess, isn't it? But, and you know, interest charges are going to continue to go up.
Yeah.
UK claimant count. I read an article in the FT yesterday about UK employment data, which apparently only 15% of companies reply to the National Statistical Office inquiries for employment data. So the data is now effectively deemed to be useless. But they still publish it because they have to.
Well, so what they've done is this data, the claimant count data, the unemployment data, it used to be, as you say, from the labour force survey. And they, a decade ago, they used to get 50% response rates, now 15. Yeah. And so they've now gone to this experimental series using real-time payroll data, which leaves us, frankly, in a total mess.
Indeed. So our unemployment rate is 4.2%.
Yeah, but that's the trouble is they've now revised it to saying it's 4.2%. Previously, they were saying 4.3% using the old survey data. So where does that leave us? Has unemployment gone up or down?
Yeah. And this is the UK employment change. The number of people employed has dropped by 200,000. Again, I think we have to view this data with, I think payroll data is probably the real payroll, in terms of real-time reporting under PAYE, payroll data is probably the most accurate that they have at the moment.
Yeah. Actually, sorry, Richard, I should explain. So the chart shows the payroll data using the old time series. that stops in June. Okay. And so the way Trading Economics reports the data, the July number was minus 82,000. But because the ONS has termed this new series experimental, they have not added that data to the chart.
Right.
So you need to add, for July, minus 82,000.
Right.
Yeah, that's the sort of mess we're in, frankly. There's a new series with one data point.
So we don't really know.
Yeah.
UKSP Global Manufacturing PMI, still in that downtrend, basically. It's been in for nearly 2 years. The UK Services PMI, just around about neutral. And the composite PMI, a little bit below neutral, as you'd expect. Business optimism is not very good. I mean, business optimism has been not very good for a long time, but
Yes.
although we have inflation, we don't have a recession.
Yeah. No, that's a very good point, Richard. Yes.
So everybody's worried about something which hasn't actually happened.
Yeah, that's true.
And CBI industrial trends orders is quite low, actually, and not looking great.
Yeah. And actually, let me read this out. The warning lights are flashing red in our latest manufacturing survey, with business sentiment deteriorating, output volumes falling, and manufacturers becoming more cautious over their employment and investment plans. CBI Deputy Chief Economist Anna Leach. So not great. And that's the October number.
And the distributive trade index is on a very noisy but fairly sharp downtrend, and it looks like it's still on that downtrend. So retail not looking great. Car production, they're sort of stabilized very noisily between 50,000 and 100,000.
Yeah, but I'd say the trend is up. And last month, when there's this huge collapse, we said that it was because that factories were retooling during the summer holiday season for EV production. Actually, if you look into the numbers, we are exporting more cars now. So that's actually quite good.
We've got labour market statistics that are a little bit difficult to interpret. I mean, we know the labour market is still relatively tight. It's not that inaccurate, but trying to identify where the trends are has become a bit difficult. So the ONS is trying to find a better way of doing it. And the UK PMI is showing that economic activity continuing to decline, but it's pretty slow decline. And but I think the distributive trades one is actually quite interesting because that shows that's a more indicative of discretionary expenditure.
Yeah. Okay, thank you, Richard. On to the EU. Now, this is EU consumer confidence for October, and it declined, but not as much as expected. And moving on to the PMIs, well, the manufacturing PMI, that is a really awful number. 43, lower than expectations, lower than September, and really at lows not seen outside major recessions. Service PMI also fell, missing expectations, and actually now is in decent contraction territory, which leaves the composite worse than expected and down on September. So all the indications are that the EU economy continues to slow as the lagged effect of the rapid rise in interest rates begins to take effect. And this is loans to household year on year, declining rapidly. And money supply in the Eurozone fell 1.2% year on year in the year to September, although you see it actually picked up a bit in September. So if you believe that inflation is always and everywhere monetary phenomenon, then inflation should be coming right down. And the Citigroup Economic Surprise Index has actually improved for the Eurozone. So perhaps the rate at which the economy is surprising to the downside is easing. And this is from John Authors at Bloomberg this morning, and it shows credit conditions in the Eurozone. The blue bars are banks reporting that they're tightening loan standards, credit standards, and you see that is continuing. But at these rates, demand for loans is collapsing. So in summary, the latest PMIs show that the EU economy continues to slow, although the pace of that decline is slowing. Consumer confidence remains poor. And on to the US, Richard.
Thank you, Keith. So, as Keith said at the start, US GDP growth for the last quarter, 4.9%, was an astonishingly large amount. Quite possibly to be put down to the expenditure on the chip and what was that, the Inflation Reduction Act, and quantities of taxpayers' money that government debt going into the economy.
Actually, Richard, I don't think that's true.
No?
I think if you look here, it's all personal expenditure basically, and a rise in inventories, which is not sustainable.
Certainly, the Fed is going to be wondering what it has to do to slow the economy down.
Well, I know. Yeah, and we are going to show you in a bit a chart. One of the Feds, I think it's the New York Fed, produces the effective funds rate index, which shows the price of money in the real world. Obviously, the Fed sets base rates, but then, financial entities add their own spread, and the effective rate is higher, and the effective rate is about 7%. So, you'd expect that to be slowing the economy, but it hasn't.
Not. So consumer, as Keith just said, consumer expenditure quarter on quarter growth is 4%, with consensus expectations of 0.7%.
Yeah. And we previously talked about there were indications that consumers were slowing spending on their credit cards as credit card interest rates hit pretty much an all-time high. And, then you get the data and they've been melting the plastic. They've been using it so much. Well, they've been spending so much anyway.
Exactly. So, and US PCE quarter on quarter just ticking up a little bit there to around about 3%.
Yeah. Actually, that is not a good number.
And also, it's really a long way away from the consensus.
Yeah.
It's 30, actually, it's about 40% higher than the consensus expectation.
And frankly, when the consumer's spending so hard, that's not a surprise, is it?
No, it's not. Core PCE quarter on quarter is continuing to fall, though.
Yeah, you see, but this is a good number. Actually, this is a surprisingly good number. So excluding energy and food, then actually inflation really is coming down, looks all right.
Yeah.
So the PCE, that must mean, we know that energy prices did bounce, oil prices did bounce in Q3. So that must be responsible for the beat because core came down nicely.
Yeah, exactly. So US Chicago, the National Activity Monitor. What activity is it monitoring, Keith?
Well, reminder, 0 means the US economy is growing on trend. Yeah. But actually, we've had this is the September number. We've just had Q3 GDP. And actually, if you sum this up, you get to about 0. We know that it grew much faster than average. So, how reliable is this?
Yeah. US global manufacturing PMI at 50, so not slowing.
Yep.
The US PMI employment indicators all showing a continuing gradual fall in employment, but still in positive territory.
Well, actually, the manufacturing, you'll notice, has dipped negative for the first time since 2020.
Yeah, that's true, actually. Very slightly, yeah.
Yeah, very slightly.
And for the global services PMI, just above 50.
Yeah, beating expectations though, rising instead of falling.
Yeah. And composite PMI looking very much like the services PMI, actually, just above 50 and rising. And US new home sales continuing to rise.
Yeah, I found this absolutely mind-blowing. We know that new US 30-year mortgage rates are about 8%. That house prices have actually risen year on year. And so housing affordability is close to an all-time low. And yet people are still buying houses. It is absolutely mystifying. Now, I spoke to our US fund manager friend yesterday, and he said that this may be because house builders are clearing inventory. They can see a slowdown coming and they're trying to get as much off their books as they can. I don't know whether that's wishful thinking or not, but
But it's a possible explanation, isn't it, Keith? With a bit of discounting, although I'm not quite sure about house price data. Anyway.
Yeah.
Okay, so US new home sales month on month. Well, there we are. That's what we've sort of just seen in the other graph.
Yeah.
Bit more
absolutely amazing. The thing is, those sales would probably have been agreed a few months previously, but still.
Yeah. Pending home sales month on month, increasing 1.1% up. So obviously August was a very slow month, holiday season, I guess, and it's picked back up now. And pending home sales year on year, it's climbing from that quite fast from the nadir of a few months ago.
Yeah. But if you look at an absolute scale, well down.
Yeah. So durable goods orders month on month, a really strong figure there.
Yeah.
And durable goods orders ex transport month on month, a moderately strong figure, but it's interesting. Transport has taken up so much of that durable goods orders.
Yeah, it's another big plane order, basically. Really flies around.
Yeah. Red book retail sales growing fast.
Yeah, that is a big number.
30-year mortgage rate, as Keith has alluded to, for all intents and purposes, it's now 8%.
Yeah. And you'd expect this to be slowing the housing market. But, it ain't. Not for new sales. For existing home sales, it is. It's killing it. But,
Yeah. Mortgage market index just continuing to decline.
Yeah. So how are people affording all these new homes?
Cash buyers?
I know, but surely you'd run out of cash buyers eventually.
One would think so. Yeah. It's a bit of a conundrum. The data doesn't really hang together, does it? Isn't it? So US initial jobless claims, they're pretty stable, really, between 200 and 220,000 for the last few months.
Yeah.
And continuing jobless claims, however, are starting to show a rise, but not a huge rise, but a bit of a rise.
Well, I found these numbers odd. Okay, so we know there's strong seasonal adjustments, particularly for the continuing. But here you're talking about initial jobless claims that are stable around 210,000, as you've just said. But then you've got a 63,000 rise in continuing jobless claims in 1 week, which suggests that a lot of those people, a ridiculously high proportion, are not coming back into the labour force.
I think that you have to view this data as a bit of a pinch of salt, Keith, in the sense that you can probably take it over a long period of time. And March to September, pretty much unchanged. I suspect that the week-on-week changes until you have a significant sort of series of data points, as you had from November 22 to March 23. I suspect those are very difficult to actually apply any interpretation to.
Yeah.
And the New York Fed weekly economic GDP estimate. Well, it's fairly. Is it fairly accurate from what I can see here?
I don't think it is, actually, given we know we just had a blistering hot Q3. But
But
I
this is
mean, the point is that they're showing that, GDP currently live is doing just fine. Thank you very much.
Yeah. And the economic surprise index is surprisingly positive.
Yeah, continuing to surprise the upside.
So we've got this. The US is not slowing down. Employment is good. GDP growth is very strong. PMI is good, and the housing market is good.
Yeah. Yeah. So, we've been forecasting recession for a long time now. And then Q3 numbers come in and it's the exact opposite. Does monetary policy work anymore? Question mark.
Well, that's a good question, isn't it, Keith?
And we have no new China data this week. Next week, we have the PMIs. And onto one chart. Now, this is the deficits in euros for Italy, France, and Germany. And we've all been talking about Italy and, this potentially irresponsible budget passed by the Meloni government, leading to a sell-off in Italian bonds. But the problem is actually France. Look at that.
So France is so big, it's unbailoutable. It has very high debt levels, and it has a banking system which is hugely leveraged.
Yes. So we've talked about this before. France is, very high debt levels. But you see the German budget deficit is improving very rapidly.
Yeah.
And France, I mean, this is scarcely believable. It's right back at its pandemic lows. And actually, Italy, at least you can say it's cut its deficit by a third since the lows of the pandemic. France, it ain't. So
no, and the French are incredibly resistive, as we know, to the French government trying to do anything to reduce public expenditure.
Yeah.
So that only ever happens when the French government debt position becomes completely unsustainable.
Yeah. And on Richard's point, the French debt levels, 110% of GDP.
This one should point out is with having had inflation at 10% for over a year, very roughly speaking.
Yeah. Whereas, so you can see German debt's GDP has benefited from that. France, well, you can't keep on spending like that when inflation is coming down rapidly, because then your debt's GDP is going to go through the roof.
Be careful what you wish for.
And onto errors and corrections. Now, last week, I did this piece about, why haven't US interest rates caused a recession? And a viewer who wishes to remain anonymous emailed me to point out that I had, of course, missed out the role of fiscal policy. And we turn to the GDP formula. So GDP is consumption plus investment plus government expenditure plus exports minus imports. So the rise in interest rates in the US, of course, affects everyone and their ability to borrow, apart from the US government, which can just keep on spending. It just increases its deficit to pay for its increased interest costs. And so in 2023, the US fiscal deficit has risen by 600 billion to 1.5 trillion in the first 11 months of the fiscal year, and that's to August, or from 3.8% to 5%. But that 5% includes an accounting change to allow for the end of student debt forgiveness. If you exclude that, the deficit actually rose to 7%. So that equates to a fiscal impulse of 3.2%. So really, it's not surprising the US economy is doing very well when they've increased the deficit by 3.2% in a year. And this is from the Brookings Institute, and it breaks it down. Now, this is very interesting because what it shows is the main reason for the increase in the deficit is a fall in revenues. And that actually they've only increased spending on Social Security, Medicare, and Medicaid by a small amount. And actually, they are still spending on pandemic-related programs, but that spending has been falling. Net interest increased by 20%, and that will keep on rising. Now, why have US tax revenues fallen so much? So the Brookings Institute say it's because lower capital gains, because of the performance of the stock market, higher than normal tax collections during the pandemic, and we'll show you a chart in a second. Unexpectedly high and potentially fraudulent take-up of the employee retention credit, which we talked about before, has now been suspended because they were getting so many fraudulent claims, and also because of this tax filing extension for California, Alabama, and Georgia. Now that has been postponed again to November the 16th. So they still haven't got that money. Also, something we've talked about is that you can apply in the US to postpone your personal tax payment by 6 months. And when interest rates were low, there was no advantage doing that. But now interest rates are high, you can stick that money in the bank for 6 months and get 5%. And anecdotally, lots of people have been doing that. Now, the bad news for the US is that if you look at income tax receipts as a percentage of GDP, well, actually, they've just returned to normal. So, yes, there's been a big drop, but there was this artificial boost to tax revenues during the pandemic, and that implies that the fiscal deficit is likely to remain here unless they do something about it. The good news is the rise in the fiscal deficit that we've seen in 2023, which has been enormous, 3.2% of GDP, will not be repeated in 2024. So that will not continue to boost GDP, is the flip side of that. But the bad news is that the fiscal deficit looks unsustainable at these levels because that fall in revenues does not look like a one-off. That looks like a reversion to the mean. And this is the flowchart of the US deficit this year. And you'll see they brought in total receipts of 4.4 billion and they spent 6.1. So they are spending, for every $4 they bring in, they're spending 1.7. So as a proportion of their income, the deficit is just absolutely enormous, about a third. The good news is, now that student debt forgiveness has been abandoned, the deficit appears to be back in line with its long-term trend. And on to inflation watch this week.
Thanks, Keith. So we don't have any new numbers for inflation this week. So there's not much to add to what we said last week. We will update this in due course. This is US trueflation, which is stabilized at around about 2.3%.
Yeah, i.e. not much, very close to the Fed's target.
And UK trueflation is continuing to fall quite sharply, which, fingers crossed.
Yeah, actually, if you step back and look at this, December last year, it peaked at 22%. It's now at 6.2%. I mean, inflation in the UK, according to Trueflation, is falling very rapidly.
Yes, indeed. And let's hope we continue to do so.
Well, absolutely. Of course, that means that we have experienced a huge inflationary surge, and those prices aren't coming back down. But, the pace at which they're rising is really ameliorating.
Yes, I just think we have to be wary that typically, as I said before, historically inflation declines in waves,
Yeah.
and if that were to be repeated on this occasion, we've got one or two more waves of inflation to go.
Yeah.
So US PMI prices continue to fall. So that should presage further falls in inflation, with the caveat of what I've just said. Used vehicle prices are beginning to fall again, down
Yeah.
18% their peak, but still very high in comparison to their pre-pandemic levels.
Well, exactly, Richard. I mean, compared to their pre-pandemic levels, you're talking about what's that, 40% higher? That's a hell of a
Yeah.
lot.
Okay, so the Baltic Index, Container Freight Index, has fallen all the way back down, and it bounced around the level that it is currently bouncing around between October 16 and pandemic. So it looks like it's probably arrived roughly at its base point. So this is core CPI, which we've talked about, ex shelter, and that is now at 2%.
Yeah. So this seems to show that, the Fed has succeeded in its aims. And actually, inflation is right back down to where it should be.
Well, not really, I would say, because one of the issues with the inflation measurement was that they excluded house prices in the first place.
Okay.
And house prices haven't dropped significantly yet. So I think this is it's like slicing and dicing the data until you get what you want to see in some senses.
Yeah. Okay. I accept that.
So the US working age population has grown as a result of immigration. How do we
Yeah.
know that?
No, we did. So last week we showed this chart where it showed that actually there have been 5 million immigrants into the US since the pandemic. And so background to this chart is that actually I produced this segment on US demographics, which I'd been struggling to find space for literally months. And I went to update the chart. So previously, the data ended about here in 2022. And the commentary was that, the US working age population was stagnating. I then went to update the chart and saw that it shot up by 1.5 million, and that's all immigration. Amazing.
So, inflation seems to be falling everywhere.
And onto the term premium. Now, previously, when I've talked about my disastrous investment in long bonds, I have said that the economy, the UK economy, the US economy, cannot live with bond yields at 5%. And one of our viewers, Mr. C. Peckham, has taken me up on that. And his point is that actually government bond yields have just returned to their long-term average. And one of the reasons for that is that the term premium has risen. Now, previously, I've said that UK 30-year bonds yielding 5% imply that the market is expecting UK interest rates to average 5% over the next 30 years. Well, that's not correct, because it's the government bond yield, the 30-year yield, is the sum of the expected average short-term interest rates over those 30 years plus the term premium. So the term premium is the difference between the long-term bond rate and the expected average short-term rates over that period. Now, in theory, the term premium should always be positive, because long-term bonds are risky. Why would you invest in them unless there is an incentive to do so? But the term premium actually over the last decade has largely been negative, and that has been presumably because of QE. Now, you can see that the term premium had previously been trending steadily lower as essentially the volatility of inflation and the volatility of interest rates had fallen. So the risk premium for holding longer term bonds had been falling. But the last decade has been extraordinary, where it's been negative. And so investors had actually been paying a premium to hold longer term bonds. And Mr. Peckham's point is basically we've just returned to normal. So this is a view just over the last decade, and you can see that it's been mainly negative and actually extraordinarily negative during the pandemic. So if you break down the US 10-year and the rise in recent yields, you'll see that actually inflation expectations have risen a bit. The term premium has risen a bit, and there's this expected increase in growth expectations, which just seems ludicrous, frankly, but I think is highly correlated to the current economic performance of the US, which is, as we've seen, has been doing very well. Now, history shows that in the long-term bonds outperform cash. Now, it's very difficult to see on this chart because the long-term performance of the various asset classes is dominated by the S&P 500. And so that's interesting in itself. What it's saying is you should really stay in equities as your default. And if we look at it on a log scale, you'll see that equities have outperformed every other asset class by a factor of 10 since 1928. So your default position should be long equities. But if we're talking about the term premium, you'll see that the US 5-year, which is the green line, outperforms the red line, which is cash, and that is because the term premium is positive. So through history since 1928, the term premium has on average been decently positive, and it's better, therefore, to hold long-term bonds than to hold cash. So that brings us on to the bear case for bonds. Now, clearly, my trade in bonds has not been working, and it's been absolutely terrible. And the bond yields have returned to 5%. And if you think about how that breaks down, there's 1% term premium, 2% real growth, 2% inflation. Actually, 5% on the US 30-year would seem quite reasonable. And so there is therefore no bull case for bonds. In fact, you expect bond yields to be, stable around these levels. And I can't disagree with that analysis. The long-term level of bond yields at 5% would seem quite reasonable given the US performance of the US economy right now. But my trade in bonds is not an argument about the level of US bonds. It's a cyclical argument, and it's an argument about how you expect that rapid rise in interest rates. Reminder, US interest rates have risen from 0.25% to 5.25% very rapidly. And I expect that to rapidly slow the economy. Now, in the US, that has not happened. But in the EU and the UK, it is happening. And so, reminder, the world economy is highly indebted. As those existing debts are refinanced at much higher interest rates, that reduces demand. And that should slow the economy. In the EU and UK, that is absolutely happening. In the US, not so far, but it still should. Also, asset prices have been very high as a result of years of very low interest rates. And now that interest rates are higher, asset prices should fall. In the case of bonds, that has absolutely happened. In the case of UK housing, that is starting to happen. In the case of equities, that really hasn't happened yet, although we've had a bad week in US equities. But you would expect that a higher discount rate would mean that the cash flows you can expect from your equities should be discounted at a higher rate, and the price of those equities should fall. And when that falls, when equities fall, so the wealth effect should reduce demand. And one of the reasons I think that US personal consumption has held up so well is that the equity market has held up so well. The US is a highly financialized economy. If the US equity market falls sharply, then I think that could finally start to reduce US personal consumption. Investment and all long-term purchases are a function of the cost of credit, and higher interest rates should reduce investment, and that should bring economic growth down. So my argument for buying bonds is not on the level of bonds. It's a cyclical argument that higher interest rates slow the economy, bring inflation down, and as inflation comes down, so real yields should come down and bond prices should rise. So if you look at the UK's total debt, it's an astounding 1,000% of GDP. But that's because we've got a very large financial system. If you look at private sector debt, then actually it's down from its GFC highs, but still an astonishingly high 194%. And the reason the private sector has been allowed to deleverage since the GFC is the public sector has increased its debt. And so if you add private sector to public sector in the UK, you get debt to GDP around 300%. So higher interest rates work on the stock of that debt, in particular as mortgages are refinanced at higher interest rates. So that increases personal financing costs and reduces demand. And we're seeing that in the UK. In the US, rates are also rising. This is car loan rates shot up from 5% to 8%. That's a big rise. And you're seeing a rise in US defaults on their car loans as a result. And this is credit card rates, which are pretty much close to an all-time high. And small businesses in the US are now paying 10% on their loans, and that is higher than they've paid since just before the GFC. 30-year mortgage rates are at 8%. And as a result, US consumers are spending more on their debt servicing costs. All of that is as you would expect. But as we've seen from the GDP numbers, so far it has not slowed the US economy. Now, US small companies face a steeper refinancing wall than large companies, and we know that their current borrowing costs are very high. If you look at investment in the US, and this is investment in IT, then you'll see it's falling as the cost of capital has risen. And when we now turning to the price of bonds, well, in the UK, the price of bonds essentially is discounting the UK interest rates staying high forever. So expecting the Bank of England to cut interest rates to a minimum of 4.5% as the economy slows, and that's over the next 3 years. But the reality is that when the Bank of England cuts rates because the economy is slow, it tends to cut them very hard. And so if you look here, 1990, it cut rates from 15% to what's that? Just over 5%. In the GFC, it cut them from 5% to essentially zero, and they stayed there for a decade. So I'm expecting the UK economy to slow sharply, because that is a very sharp rise in interest rates, and that to lead to recession, Bank of England having to cut interest rates hard, and long-term rates are highly correlated with short-term rates. So as long-term rates come down, so bond yields should come down. Now, I've been way too early, but I still think that dynamic will play out. Richard, what are your thoughts? Bull or a bear on bonds?
So my thought on this, Keith, is that the and I don't have a crystal ball, but if you look at that long-term chart, up until basically the GFC, the interest rate never dropped below 5%. So an alternative argument would be to say that the interest rate is now normalized, and for 5% is at the low end of the range for the current level of inflation that we've got. So my question then is, well, what happens if actually interest rates go up to 10%, and then when they're cut, they come back down to 5%? Well, and I don't. So my point here is that there's a danger of basing what is going to happen now with a very short period of time between 2010 and 2020, and that I think that is, one has to be careful doing that, because the whole shape may revert to how it was previously. Yeah,
well, obviously I've been totally wrong.
As to why interest rates at 10% could be very damaging. I get all of that, but things that could be very damaging happen. So that's my concern with this.
Okay, no, I accept that, but I would say that interest rates of 5.25% are slowing the UK economy and bringing inflation down. So why would they rise from here? Nobody's expecting them to rise from here, frankly, because inflation is dropping rapidly, as we talked last week. When the October numbers for CPI come in, so the 2% month-on-month number in October 22 drops out of the comparison window, which should mean UK inflation falls to 5%. So if UK inflation is slowing quite rapidly, we've seen that the claimant count is rising, unemployment is rising. So the interest rates here are at 5.25% are slowing the UK economy. And I'm sure friends whose mortgages are coming off their old 2% or less fixed deal and having to refinance at current rates. And I had dinner with a friend on Wednesday who was saying, her mortgage is just unaffordable. They can afford it for a year or two, but after that, they basically have to sell their house. They're using up savings to afford their mortgage. So every month, more and more UK households are having to refinance the mortgages at these rates, and that just reduces demand and slows the economy. So
you're right, Keith. I don't dispute what you say, but that is my caveat on this strategy.
Well, frankly, this strategy has not worked. It's been a total bloody disaster so far. But, it's a cyclical trade, and it might take quite a long time for me to get my money back. Frankly, if you look at, last time the Bank of England cut interest rates, yields did fall, but actually it took several years for them to come down to, they never came down to, they did. They did come to 10-year yields, came down pretty much to zero, but, it might take a long time for me to get my money back. Anyway, on to recession watch, Richard.
Thanks, Keith. So since this is a cumulative change in financial conditions, and the financial conditions index has has risen by another 80 basis points. So the higher the line, the tighter the financial conditions are. So on this basis, the US has very tight financial conditions, and therefore the US economy should be slowing down, as we
How many times have we said this?
a broken record, Keith.
I know. Well, I am,
And the San Francisco Fed's proxy effective funds rate is around 7%. I mean, we've talked about it. We've got mortgages at 8%, and so interest rates in the real economy are high now.
So if you look at this, if the effective Fed funds rate was 0, it's gone from 0 to 7%.
Yeah.
And the US economy is just doing fine. I mean, honestly, I thought the US economy would be dead as a dodo.
It's doing fine until something breaks, Keith. Something's going to break, I suspect.
Well, I've been just so wrong on this. I thought that would kill the US economy.
If something breaks, then you'll be absolutely right, and bond yields will suddenly plummet.
Yeah. Let's pray for Armageddon.
Armageddon everywhere else, Keith.
Yeah, exactly.
Well, not really. So the Bloomberg Economic Surprise Index is beginning to fall, although the Citigroup Economic Index isn't. Yeah. So there you go. Pick your series.
Pick your poison. And
investment in US real estate, it has a lower yield than the US 10-year. And we know what's happening in the US office space sector. It's a bit of a bloodbath, I think, and becoming more so with high levels of vacancies.
Well, we talked about the US housing previously and how it's holding up very well. Well, as an investor, why would you invest in US housing when you can get higher yield buying the 10-year Treasury bond without the grief?
Yeah, exactly. So credit card, total credit card debt levels are not rising particularly, nothing extraordinary there. The 90-day delinquencies are rising quite sharply, but they've got a long way to go before they get to the sort of 2009, 2000 levels. So householders having difficulty paying expenses. Just look at from June 22 to now, significant increase over the sort of pandemic period, but it's like, I don't know. We'd need to see that line go up significantly to think that there was a trend as opposed to just a data.
Well, as you point out, Richard, we've just had this blistering hot GDP number when a third of US households are saying they find it difficult to pay expenses. Doesn't seem very compatible with reality. But anyway,
there's a lot of inconsistencies in the data that's coming through. Definitely.
Yeah, but the one thing you can say is there was a significant jump in October.
Yeah.
Is that due to student loan repayments? We just don't know.
US trucking activity. Again, the difficulty with this is how do you put this into perspective as to the economy? Because from 2009 all the way up until pre-COVID, it was on a sharp upward trend, and now basically it's leveled off. So it's difficult to know what it's telling us.
Yeah, well, it's showing that there hasn't been a lot of goods moving around the US economy when we know that in the last quarter there were a lot of goods sold in the US. Consumer spending was very good. So
and Americans struggling to afford car payments, 6%, which suggests there's going to be a bit of a delinquency problem. But given that I don't know whether the loan interest rates on these are as high as credit card rates, but the lenders have certainly got a margin, even if the consumers are struggling.
Yeah, I would also say that the commentary is that a lot of these defaults related to loans that came out in loans that were made during the pandemic.
Yeah.
And actually the default rate on car loans taken out more recently is lower.
And US light vehicle sales are holding up. As the economy is holding up, so are the light vehicle sales.
Yeah.
And high yield is just starting to pick up back up again. It started to pick back up in January, February time, didn't it? And it fell back down.
Yeah.
So it needs to go further than it has currently before it starts. We start to think maybe it's signaling something.
Yeah, I agree.
CMBS spreads are pricing in a wave of defaults. This would be defaults on mortgages.
Yeah. Yeah, presume that's office.
Yeah.
So this shows the revisions to US GDP forecasts. The brown line is Q3, and we know that came in absolutely blistering hot. So since May, you've seen massive revisions to the Q3 number, now past. You've seen big revisions, positive revisions for Q4, but revisions for Q1 next year and Q2 next year have actually fallen over the period. So economists are expecting this surge in activity in Q3 just past and in Q4, but then they're expecting the US economy to slow in Q1 and Q2 next year. So another way of looking at it is that they're still expecting a slowdown. It's just they keep on pushing it back.
And this is a cumulative maturity of bonds and loans percentage of total. And so in the next 4 years, really, up until 2008, something like in European small caps, 80% of the bonds and loans will have matured. And in government debt, we're looking at 60%. So there's an awful lot of maturing debt coming up. Go on, you do this one, Keith.
Well, this is just showing that from the start of the inversion of the yield curve, it's around 24 months to the start of recession. In fact, in 1970, it took 50 months. So we're now, 12 months in? And, what it's saying is that just because the recession hasn't happened, and to be clear, the recession in the US has very, very much not happened, given that they just had a 4.9% quarter-on-quarter annualized number. Well, it still can happen.
So far, as we say, monetary policy hasn't slowed the US economy, but there are various things that suggest it might be slowing. But, we are a bit like a broken record on here. And
yes.
The economy should be slowing, and therefore slow.
Well, that chart from the San Francisco Fed of the proxy rate, if you had told me that interest rates would rise by 7% in a year and the US economy would just blithely carry on, I would have thought you were smoking the strong stuff.
Yeah.
But I've been totally wrong. And on to soft landing watch. Well, obviously, the US economy is doing just fine currently. And actually, spending on the CHIPS and IRA acts will continue and will continue growing over the next few years. And that should provide a tailwind for the US economy in the coming years. So, and also the US manufacturing sector, if you look at the new orders over inventories level, new orders are rising and inventories are falling. So has the US manufacturing cycle bottomed? Actually, when we talk about the strength of the US economy and how tight the jobs market is, I thought this was really compelling evidence that the US job market continues to be fine. So this is new job postings on the website Indeed. So that's job postings within the last 7 days. And you'll see that it has been slowing, but that the slowdown has been really slow, and 100 is just before the pandemic, well, overall, the US jobs market appears still to be doing just fine and very tight. But if you break it down, the tightness is in jobs that are not remote working. Now, I take this to be a proxy for white collar versus unskilled labor. And so there's still a lot of jobs that require people in person, like restaurant jobs, whereas remote working jobs, actually, that's gone negative. And we know from the Bank of America data reported last week that the redundancy rate, the unemployment rate in people earning above $125,000 in the US has risen and is now above normal. So this is further evidence that the slowdown is concentrated in higher paid workers in the US. And the post-pandemic travel boom continues, and US flight demand right now, late October, it is an all-time high. So bottom line, the US economy is doing just fine, frankly, and the CHIPS and the IRA Act mean that infrastructure investment will continue to grow in the next few years.
I think, Keith, basically it's as we've always maintained, isn't it? These interest rates aren't going to affect anything.
I wish I'd known that last year, Richard. I really thought that 7% interest rates would just kill everything. And it's just been, hasn't happened. Okay, so what is US oil production? Now, and I reported last week how the EIA numbers show that US oil production has seemingly surged from 12.2 million barrels a day in July to 13.2 million now, despite the rig count not going anywhere. What's going on? Well, it seems actually that surge in production is illusory. So HFI Research have done this analysis, and what they're saying is that the EIA had previously not incorporated plant condensate into their numbers. So plant condensate is hydrocarbon liquids produced as a byproduct from natural gas production, and it's produced when the natural gas is processed in the plant. And as US natural gas byproduct has risen from shale oil production, so plant condensate has risen. And the EIA had not really accounted for that. So if you look at the green line, this is HFI's Research's estimate of US total oil production, including plant condensate. And the dotted blue line is the EIA's estimate of US oil production. And it seems that essentially their line is just catching up with reality. And this is HFI's estimate of plant condensate production in the US. So as shale gas has increased, so has condensate. The irony is that HFI Research are now estimating that plant condensate has kind of peaked and coming down. So, that surge in US oil production that the EIA are reporting may not last, and HFI are now forecasting that US oil production is likely to have peaked for the year. But they are estimating that US oil production is closer to 13.6 million barrels a day than the 13.2 reported by the EIA. So bottom line, there hasn't been a surge of 1 million barrels a day in US oil production over the last 3 months. It's just an accounting thing. US oil production has grown more steadily over the year, as you might expect. And on to other charts, Richard.
So the US isn't, as I think we know, is not the only overheated housing market. So we've got the London housing market, the Canadian housing market. I think the Australian housing market is very overheated as well, isn't it?
Yeah.
And I think basically, yeah, as Keith said a little earlier when he was having dinner the other night with his friend, and the impact of these interest rate rises on the housing market is going to be felt. It's just a question of time because of the fixed rate issue.
Yeah. But going back to our discussion about bonds, Richard, saying that, what happens if interest rates hit 10%? Well, asset prices collapse.
They do.
And what we've had is a huge rise in interest rates, which, if sustained, should lead to big falls in asset prices. Now, so far, it hasn't happened.
Yeah.
But it should do.
No, I agree, Keith. I agree. I know I sound a bit contradictory here, but
well, you've been right. I've been wrong.
Yeah, but and China is seeing a large outflow in direct investment. I think China is becoming quite a difficult place, becoming more difficult, isn't it? Because Xi is, from my understanding, is he's becoming more isolated, and the environment is becoming, if possible, more totalitarian. So Chinese, the property construction decline is being offset by growth in service sectors. It's quite interesting. Property construction, though, is 35% or was 35% of Chinese GDP. You've got to have an awful lot of, I know, the whole property sector hasn't disappeared, so clearly it's not a 35% deduction, but you've got to have a huge, to substantially offset the impact of the problems in the property sector, you'd have to have a very big growth in other sectors. Question mark.
Well, this chart is showing that that's happening.
Yes. I'm just sticking a question mark in front of it.
Yeah, well, I'm with you, mate. All the numbers out of China should be taken with a huge pinch of salt, frankly. Start with what do you want to hear, then make up the chart.
I know. Nothing like a bit of goal seeking.
Yeah.
So the Chinese have done various things to stimulate the property market, cutting mortgage rates, moving restrictions on owning a second property, and reducing down payments. And tier 1 cities are showing a clear response to this new policy, as in a small uptick.
Yeah.
But as we consistently say, we don't really know how the Chinese data is created.
And given the number of uncompleted projects everywhere, I'm just skeptical. Well, on to some good news. And this little cutie.
Oh, the Takahi bird.
Yeah.
Well-known flying creature.
Yeah, well, it was thought to be extinct in the 1920s, but then was rediscovered after World War II, and there's been conserved in captivity and now has been reintroduced to the wild, Richard. So, doesn't it look tasty?
It does, doesn't it? It doesn't look like it can fly, actually. Can it fly?
No, it's flightless, easy to catch. So, when you're bored of turkey, they'll start breeding. Actually, why aren't they breeding them in
Do you remember Eddie
numbers?
Naktagelli?
Sorry?
Remember Eddie Naktagelli?
No.
The man who set up the ostrich farm?
Oh, yes. Yeah.
Well, he said he was going to, didn't he? I'm not sure he ever actually set it up. We could have a portfolio matters Takahi farm.
Well, honestly, they look very tasty, and turkey is a very dull dish. So, what's not to love? And we introduce an extinct species to the world. So, This is just the sort of portfolio matters trade that we like.
Into a small garden in South London.
And on to equities, Richard.
Thanks, Keith. I mean, I think equities pale into significance against the Takahi bird, but nevertheless. So the FTSE All World Index down 2.6% weekly. The year-to-date change is now reduced to just 4%.
Yeah, actually come down 10% from its highs in August.
Yeah, it's been a bad few weeks for equities. The FTSE All Share Index now down year-to-date, down 2% on the week. Actually, it was down year-to-date before that, but the Euro stocks down 1.6, still slightly up year-to-date. The S&P 500 down 3.3%, still up 7.7% year-to-date. I mean, my view would be a little bit of sanity is coming into the equity markets. But
Yeah.
I would say that, looking at the previous 10 years, that is not necessarily likely to prevail for terribly long. The Nasdaq Composite down 4.5%, so it's now only up 20% for the year-to-date.
Yeah, that is a big fall in a week, though, 4.5%.
Yeah, I think Google apparently announced excellent results and fell 8%. The Russell 2000, which is more of a reflection of the US economy, I think, than either the Nasdaq or the S&P 500, is down 6% year-to-date, 2.7% on the week.
Yeah, the Russell 2000 is behaving as you would expect.
Yeah.
Particularly given that we know that loan rates for small companies are now 10%.
So the Hang Seng had a minorly good week against that backdrop, but still down 12% year-to-date. The Topix unchanged and up 20% year-to-date. Bitcoin had a good week, actually, up 17%.
Amazing.
Don't know what triggered that, actually.
Absolutely amazing. Up 100% year-to-date. Wow.
Maybe the fact that Bankman-Fried is going to be giving evidence. Pound is, well, it didn't do very much, did it?
Yeah.
It is, I would say, worryingly down against the dollar, just generally.
Well, frankly, when you look at the US economy versus the UK economy, US interest rates as high, but the US economy is doing much better. If you're going to invest somewhere, you'd do it in the US, wouldn't you? Just a reflection of that, I thought.
Yeah, no, you're quite right, Keith. I just think from a domestic point of view, I'd like to see the pound a bit stronger, but I understand why it's not.
Yeah.
My holidays, Keith.
Well, I think we need to have a sensible government for that to happen and some just certainty.
Yeah. So which planet are you living on? Remind me.
Not the one I'd like to.
The euro down, well, pretty much unchanged on the week, slightly down on the year. Very similar chart, actually, to the GBP. And the dollar index, having risen fairly substantially since July from that 100 point, its nadir 100, is now stabilized at 106-ish. And the VIX is, because of, VIX is basically the reverse of the S&P 500, isn't it? Very roughly speaking.
Well,
so
I found, frankly,
down and the VIX is up.
Well, I found this absolutely amazing, Richard. So the Nasdaq fell 4.5% this week, and actually VIX is down.
It's not down on the graph, Keith.
Sorry?
It's not down on the chart.
Well, on a weekly basis, it depends, here compared to, it must be there.
Oh, there. Yeah, I see. Yeah.
So, but also, remember that the rule was you sold VIX below 20 and you bought it above 30. And here we've just had this massive drawdown week on week in the Nasdaq. And VIX is barely elevated. I mean, it's extraordinary how the options market is just not pricing in volatility going forwards.
Yes, it's very true, Keith. It doesn't. Yeah, maybe it's another thing that's changed its nature. Here we are, fear and greed. So apparently, fear.
Yeah.
Almost extreme fear is driving the market. It seems to peak last week, if I remember correctly. It was extreme greed or something. It's like blasting around all over the place.
Yeah. Is this useful? I think it's just a question of, basically just look at how the index is done to tell you how where we are, basically.
Yeah. Yeah. Okay. Is the AI bubble deflating? Is the question. I think so. And I think that. So I was reading yesterday, there was an article on Sky News, and it said, here's Rishi Sunak's speech about AI, and here's what Chat GPT or whatever they used would have said his speech was. And it was the same. And he just said, well, what surprise? It said we need to regulate AI. AI could be dangerous, but this is not artificial intelligence. It may be one day. If you ask AIs, they just take previous data and they're statistical engines. I don't understand why people say it's intelligent. It's not.
Right. Yeah, got you. But you're saying that Chat GPT correctly predicted Rishi Sunak's speech.
Yeah, but you put into Chat GPT, maybe we don't put all this online, but you put into Chat GPT the factors that you want it, and it scrapes the internet and it pulls out everything that is relevant and sort of forming. It's clever. There's no doubt it's clever, but all it's doing is it's taking what other people have said at different times and pulling them together. It doesn't create anything new,
right?
In my view.
If it's going to form its own political party, I'm interested.
Yeah, you have to ask Bill Gates about that.
Yeah.
Well, we think they've got the labels the wrong way around on this graph, and that the Magnificent Seven, being Google, etc., have done extraordinarily well. And without the Magnificent Seven, the S&P 500 equal weighted index has gone nowhere in the last year.
Yeah,
makes sense to me.
Yeah, absolutely. But are the Magnificent Seven finally rolling over? Their PE ratios are just silly. And to be fair, Q3 results have been very good. And this chart shows rising bond yields at the top. And normally, rising bond yields equate to falling PE ratios. But that hasn't happened so far yet. Is this time different? I mean, surely rising bond yields should lead to rising earnings yields on equities, which is the flip side of the PE ratio. And analysts have started to downgrade their earnings estimates. So should that mean falling equities?
So the Russell 200 is back at its pre-pandemic levels, the blue line, having had a bit of a splurge. It's been sort of bouncing around post. So anyway, it's back at its pre-pandemic levels, as we've discussed. It's not had a very good year.
Yeah, absolutely. So, US small companies, they've performed nothing over the last couple of years. And falling as you would expect. Now, actually, I was reading an article during the week that was reminding me, we've talked about this before, how in the long term, 60% of listed companies in the US go to zero. They provide no economic return at all. And actually, in the long run, all those returns, equities have equities have outperformed every other asset class by a factor of 10 since 1928. Well, that is all down to the remainder, those 40% of companies that do add value. And so what that suggests is you should invest in successful companies and avoid larger companies that have proved they can add value and ignore the crap at the bottom.
UK mid caps have also gone nowhere since 2016. It's been a long time to be invested in nothing.
Yeah. In fact, I'd say since 2014.
Yeah. Yep.
And, that's the index. What's inflation done over that time?
Yeah, indeed.
So this chart shows the cash balances of US companies. And what it shows is they've been running down their cash balances. Now, So what they've been doing is they've been spending on investment, research, dividends, mergers, etc., at a faster rate than they have been earning cash. So hence their cash balances have been falling. And so what that means is going forwards, they will be able to do less of that. And so corporate expenditure or dividends should fall. And that may be a drag on growth. And onto commodities and energy commodities. So as the tensions in the Middle East fail to escalate currently, so oil has come off its recent peak, down 4% on the week. WTI down 5%. Numbers specific to the oil market, well, there was a slight inventory draw in the US last week. So the US oil market seems pretty well supplied currently. Crude production was stable at 13.2 million barrels a day. It's high for the year, and the Baker Hughes rig count rose by 1. Now, shipping rates across the Mediterranean have unsurprisingly doubled in the last few weeks, and that will have a marginal effect on European oil prices at the pump. Now, Russia, you remember, has taken part in the OPEC Plus agreement and agreed to constrain its oil output. Well, you'll also be totally unsurprised to learn that they're cheating, and their oil exports have actually risen over the last few weeks, and they're now 260,000 barrels a day above their agreed target. But floating oil inventories around the world are low, and that means the oil market seems once again to be tight. Although, frankly, they're just back down to their 2018, 2019 levels, not necessarily, super tight, not below that. Now, the FT had this chart, and it shows expected oil production from Guyana at the bottom, but also from Brazil over the coming years to 2030. So actually, there's potentially a lot of oil coming online from South America. That in total is what? That's another 3.5, 4 million barrels a day.
And Biden has mended some fences with Venezuela, hasn't he?
Yeah. Now, in the case of Venezuela, it's going to take time for Venezuela to come back online, but they could, if the deal holds. And the deal with the Venezuelans is electoral reform. If the Venezuelans come through on their side of the bargain, then you could see an extra 3 million barrels a day from Venezuela in a few years' time. And the IEA are meanwhile forecasting that oil consumption will peak this decade. So does that mean lower oil prices going forwards? Watch this space. Natural gas futures in Europe were down 2%, and European inventories remain very high. So that is good news. UK natural gas futures also fell slightly on the week. US natural gas futures surged from their recent lows, up 20% on the week. And actually, that looks like the slight upwards trend is now intact as we go into winter. Coal, another crappy week, down 0.6%, down 65% on the year. And the IEA were forecasting a rapid drop in global coal consumption starting pretty much now. And here we are. So this is coal demand by region. Unfortunately, I failed to put the regions on. But anyway, you'll see that total coal demand is forecast to start dropping rapidly from here. Uranium bounced straight back up, 6% on the week. The bull market is back on. Richard will be happy. And onto industrial metals, Richard.
Thank you, Keith. So not much change on the week for aluminium. Not much change on the week for cobalt either. Well, there's a note there suggesting that the Industry Association is forecasting a surplus of 21 tons in 2024 and then 13 in 2025. So it suggests that there's going to be an excess supply of cobalt and the price will drop.
Yeah. It's not so long ago when we were talking about there being a structural deficit in cobalt.
Yeah, interesting. Copper, actually very little change, really. It's just
looking pretty sick, I'd say, actually. Most of the year.
Waiting for something to trigger an increase in its price. Chromium unchanged. Iron ore unchanged, almost unchanged. Lithium down 5%.
Yeah, that little blip didn't last.
No. Interesting news about solid-state lithium batteries from Toyota. They think they might be getting close to being able to produce them.
Yeah, I'm still skeptical.
Yes, I am too.
Because the bottom line is you need to keep these things squashed together at high pressure to stop the basically dendrites form. Lithium metal leaches out and breaks through from the anode to the cathode, short-circuiting the battery, and you need to keep these things squashed to prevent that happening. And if they get it working, great, but we'll see. They've been talking about solid-state batteries for a long time now.
Yeah. Neodymium, almost unchanged. Nickel just continuing its fairly long-term downtrend.
Yeah, another battery metal that ain't doing great.
Yeah. Tin, not doing very much really all year. Ferrovanadium is really quite sick.
Yeah, sick. Have we heard anything recently about vanadium redox flow batteries, Richard?
No, I mean, I just think they're nice ideas too, but digging a swimming pool sized battery and filling it with, it just doesn't.
Yeah, and frankly, we talk about solid state batteries, that would totally kill vanadium redox flow batteries. And actually, when we talk about the problems with solid state batteries and keeping them under pressure, that is much more doable at a large scale than it is, in a car. Yeah. So if those start being produced for industrial scale usage, that would, completely obviate the need for vanadium redox flow.
Yep, completely agree, Keith. Much neater solution. Zinc, pretty much unchanged for quite a long time, actually, since about May, really. It's been unchanged. Precious metals. So reasonably good week for gold, up 3.3%, getting very, very close to that 2000 level. In fact, I think intraday it did pierce 2000 quite recently. And the correlation between US bond yields and gold prices completely collapsed. I don't know what the scale, because we can't see the date range, but actually this happens periodically. This. You go back decades, this happens periodically.
Yeah. Well, you'd expect, like, all asset prices seem to decouple from interest rates because, the holding price of gold has shot up. So you expect gold to come down. But gold is proper money. It's been resilient.
It has. Silver hasn't followed gold, but it's pretty much unchanged on the week. And platinum is a little bit up this week. And rhodium was up and down.
Yeah, we got all excited last week. Something actually happened in the rhodium market, but then it didn't. Back when rhodium was going through the roof a couple of years ago, we talked about two companies, Jubilee Metals and Sylvania Platinum. Now, how have they done? Well, as the rhodium price has come off, So their share prices come off. And in the case of Jubilee Metals, that's down 70 odd % from its peak. Sylvania Platinum actually has done better, but still share price has halved. So there's a lot of, one thing I've really learned over the last few years is, very strong mean reversion in commodity prices. Rhodium did not carry on going to the moon, rather the opposite.
No, it's timing or exit from these things is very, very difficult, isn't it? You have to be quick.
Yeah.
But palladium, long term, well, yes, significant downtrend basically for pretty much the entire year. It's got to be related to exhaust, I would suggest.
Yeah, I agree. Well, transition to electric vehicle is just making the marginal demand for PGMs decline.
Exactly. Yeah.
Okay, thank you, Richard. And on to rates. And over the course of the last month, the UK yield curve has shifted up sharply. Well, obviously, I've lost a lot of money. Very depressing. And reminder, UK inflation is coming down quite sharply and the UK economy is slowing. So, basically, the UK yield curve is following the US yield curve, which has also shot up, and US 30-year now yields 5%. So in order for that to come down, you need the US economy to start slowing. And we've just had an absolutely blistering GDP print for Q3. The sell-off in the US 10-year has taken US 10-year yields above the long-term growth potential of the US, which it hasn't done for many years, actually. So decent real yields available for the US if inflation comes down. And the US 10-year, the sell-off in the 10-year has been absolutely extraordinary. So it's now a near record amount above its 200-day moving average. And further signs that the US sell-off in US bonds have gone too far. So you now earn less on emerging market bonds than you do on US treasuries. So does that mean that US treasuries are a higher risk than emerging market bonds? Surely not. And the short position in US government bonds just keeps on growing despite Bill Ackman folding. So bonds are now more volatile than equities, which I can very much have told you over the last few weeks. But if you look at the entirety of the world central banks, net, more central banks are cutting than hiking currently. So within the last few weeks, Peru and Poland have cut, but the Philippines has hiked. So is that the start of a change in the global monetary cycle? There's the UK 2-year going nowhere, but sadly the 10-year, not really coming down. The 30-year still at its peak, no sign of it dropping. US 10-year, it has balked at the 5% level, but not coming down yet. German 10-year, given the fall in Eurozone inflation, you'd expect that to be coming down. Italian, Greek. Greece has actually done much better than Germany or Italy. Now, any change to your views, Richard?
No change, Keith. How about you?
No. So concluding comments, well, big news of the week was that Q3 GDP in the US was just astonishing, 4.9% annualized. It is expected to slow from here, but we have said that many times before. And frankly, I would just not have expected that acceleration in US economic growth from Q2 to Q3. In Europe and the UK, the PMIs both showed that the economy was slowing, i.e. they were both below 50 and expected to keep on slowing as higher interest rates start to bite. Now, The UK labour market statistics are, frankly, questionable, but the bottom line is UK unemployment is rising and the number of people in work is falling. How did you do this week, Richard?
So I did moderately well, Keith, because the price of gold went up, and so my portfolio had a moderate increase. I'll give a proper update at the year end.
Right.
But yeah, so but nothing tremendous, and the drop down to nearly 1,800 in the price of gold that started to mid-September obviously knocked my portfolio a bit, and now it's come back to where it was before that knockdown occurred. How about you?
My God, I had an up week. I don't know how.
Oh,
I don't know how I managed to have an up week, actually. But
very well done, Keith.
Well, it's still a shockingly shit year. Now, at 5% yields, pretty much tax-free, you double your money in something like, is it 13 or 14 years?
Yeah.
So, 5%, as long as bond yields stop falling, frankly, I could quite happily just sit here and take 5% tax-free.
Yeah.
That'd be great. So, on one level, let's not disguise this. I've been totally wrong and it's been shit. But I still expect that inflation will come. Inflation in the UK is coming down. At some stage, UK is going to have to cut rates. And the market is currently expecting UK interest rates to stabilize at 4.5%. I just see no way they can do that, unless the flip side of that would be the UK housing market and asset prices would just have to drop substantially. So I'm sticking with it, and it's been terrible, but there you go. At least it stopped falling this week. Who knows what next week will bring? Anyway, thank you all for watching. Please, can you press like and subscribe to the channel? And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.